Good morning, me hearties. Hope you're all doing well. Good morning, Stel. How you doing, mate?
I'm good. Good morning. How are you? Where's Kay? Is
Yeah.
he not going to be here today?
I think he's doing more Dad's cabs. I think he's
He
driving
is.
his son to Heathrow and back. Nice, nice quiet journey, that
We
one.
we're having really severe weather here, like hail and rain, and internet's going down every 5 minutes. So if I disappear, I'll be back. I'll be back, but it might take a few minutes.
Well, welcome to our world, mate. Have some these nice blue skies here. Oh, sun's out. Oh, it's beautiful, mate. You should come over.
Well, I am coming over in about a week and a half.
Yeah, we've reserved the worst of the weather for that period you're over here for. I've put a
Yeah.
special request. Save all the rain until Stel comes over. Yeah, looking forward to that, mate. Looking forward to it.
Absolutely.
Right, well, let's get into it. The good news is, I love this period. All the central bankers are the
They're
major ones.
shutting up.
They're all shut up shop. No more ECB, no more Fed, no more Bank of England. Oh, it's bliss. I love this time. We might get the odd Kuroda and some of the others, but yeah, for the rest of them. And I mentioned yesterday, I put a tweet up yesterday. I actually went through the governing council members, and in the last, well, I'd say the last 10 days, we've had all bar about 6 of them coming out,
Wow.
all giving their chapter and verse over what they think is going to happen with rates and their view, go 50, don't go 50, go beyond March, don't go beyond March. I don't think I've seen a month where they've all literally come out in such a short period of time to push their case. So I think that really tells us that Madame Lagarde might have a little bit of a fight on her hands, or discussions might be a little heated over what they should do with rates. Obviously, the last ECB, Lagarde took the really unusual action of, pretty much saying we're going to get 350s on the trot, and the ECB, as they've told us for years and decades and whatever, is that they don't pre-commit to rate moves, particularly what the market says. So maybe that line has got a few of the doves and a few of the more cautious a bit up in arms, that she is pretty much pre-committing to rate moves. And yeah, it just makes it a bit interesting having all these ECB members coming out in a flood.
Either that, or they all sold a little bit of bond, bought a bit of euro, and then they're going to be ready to
Talking their
to,
book, yeah.
to reverse those positions just before they change their wording again. Sorry, I'm very I know I'm
Very
a
cynical. You're very
cynical
cynical.
cynical
Yeah,
guy. I know. Sorry,
cynical guy. You've got to be with these bozos. But
bozos.
anyway, let's crack on with it. We'll get the final ECB waffling out of the way as well. Right, so Reuters were out with a story saying that bullish bets on Asian FX are picking up as the easing of China COVID curbs boosts the outlook. No surprise to see that there's going to be a pickup, or there has been a pickup in emerging market currencies, particularly in Asia. We had that report from Bank of America earlier this week saying that inflows into EMs and particularly Asia were the highest on record. So obviously, if investors are flocking to those areas, they're going to need to buy those currencies to buy those bonds. So that's Reuters picking up on the FX effect from that side. That we can see a bit in dollar yuan today. Still on holiday in China, mainland China. So CNY isn't trading, but CNH, dollar CNH has moved down towards those lows again. I think this is on the back of a bit of Chinese positivity. There were some stories out that holiday spending has been very good or pretty decent. Hong Kong opened up today from the holidays, and the stock market.
By the way, Ryan,
Yep.
we can't see your screen. I don't know if you share something. I mean, you are
Okay.
just talking about headlines anyway, but it's nice
Yeah,
to see something.
Yeah, thanks, mate.
Steve in
There
a
we go.
bikini or something. You have that?
Steve in a bikini. I wouldn't want to penalise people with that sort of view. Anyway, so yeah, so you can see dollar yuan, which has been really doing nothing over the last week or so, bar bumping its head on that 679. So we have seen a bit of strength in the yuan. As I say, Hong Kong opened up smartly yesterday. Stocks up, gapped up about 400 ticks, and kept those gains. So I've been waiting to see what happens when Chinese markets reopen, to which way this one's going. I'm still running a buy stop just above 680. I am potentially interested in a longs down into this 671, 670 area, but I'm probably going to wait to see what happens when they open, and what the news is out of there. But further positivity coming out of China, which can also be a boom for commodities, oil, metals, everything really, and thus commodity currencies like the Aussie dollar, which has had another little move up today. But we shall touch on that in a moment. Over to Japan. There was a PPI services report out from the Bank of Japan, and year on year PPI for the services sector rose 1.5%, a slight miss on the expected 1.6%, but it did come in lower than the prior 1.7%. Also from the Bank of Japan, we had their summary of opinions, which is sort of like the next one on from minutes. And this is where all the Bank of Japan members have collated their opinions for the meeting, and we get who thought what about what. Overall, the opinions say it was appropriate to maintain current monetary easing, including yield curve control. They said that more time was needed to assess the impact of the December move on YCC, and that when the time for exiting ultra loose policy comes, the Bank of Japan must check whether market players are prepared for the move. We know the market is already getting quite prepared for it, in terms of what they're doing in currencies and bonds, etc. Bloomberg had a piece out saying that the fear of the BOJ turning hawkish has spurred a jump in shorter term bond sales by 94%. So this is goes back into the prior headline of whether the market is preparing for the BOJ to exit easy policy. A move into shorter term bonds doesn't get impacted as much. So we're talking, much less than 5-year tenor bonds, because there's much less impact for rate moves if those are to happen than you would get in the longer dated stuff. So maybe a bit of a shift happening there in bond markets in Japan in terms of where investors are putting their money, to either not get hit by interest rate hikes if they come, just to keep themselves out that noise. This is all part and parcel of how investors shift around when a central bank changes. PM Kishida wants to create an environment for pay rises above inflation. The government will work closely with the Bank of Japan to ensure or to manage policy actively, and they expect the BOJ to continue to manage policy appropriately. They can't say now, or he can't say now, whether the BOJ Accord will be revised. This is the deal, if you like, between the BOJ and the government as to what the remit of the bank is. We haven't heard from this guy for a while, but the top financial diplomat Kanda said he cannot tolerate rapid one-sided FX moves driven by speculative trade, such as those seen last year. It's important for FX markets to move stably, reflecting economic fundamentals. Not sure the context of this, but obviously we heard that a lot when the dollar yen and yen in general was weakening, and dollar yen was hitting all those highs up, rallying all the way up to 150s. So to hear him on the other side, maybe he's just giving it a warning that the MOF and the government and all those concerned are watching on both sides of the trade. Obviously, things are very much calmer at the moment in dollar yen, but they always look both sides of the coin. Over to the wafflers at the ECB, the last ones. Woohoo! Nagel said she wouldn't be surprised if interest rates need to be further increased after March, and is currently seeing that the economy is proving to be more robust than we thought a few months ago. McClure says we need to continue to increase rates at our meeting next week, taking a similar step to our December decisions. Also need to increase rates again at the March meeting, and continuing on a path of rate hikes beyond Q1 would not be surprising. ECB's Vasile said 50 bip hikes at the next two meetings are appropriate. From one central bank to another, we had the Bank of Canada out yesterday. Much watched for that one. They did hike as expected to 25 basis points to 4.5% as expected. Macklem and the bank came out saying that now is the time to pause and assess whether monetary policy is sufficiently restrictive. So that was perhaps the bigger news rather than the hike itself, is what they were going to do moving forward. And for now, they have gone on pause. But of course, they don't shut the door on anything, because Macklem then went on to say this is a conditional pause. It's dependent on the economy developing broadly in line with forecasts. If we need to do more to get inflation to the 2% target, we will. If upside risks materialise, we are prepared to raise rates further. We're turning the corner on inflation, but still a long way from our target. Now, what also stuck out is that he was pretty strong talking about rate cuts. And this was something I mentioned yesterday in the room that I end on the shows, that it's going to be the message that moves forward. And one of those messages is not to let the market start getting too dovish. Now they're on pause. So he was quite strong in that, saying it's far too early to be talking about rate cuts. And then later on yesterday evening on the press rounds, he said they're not even thinking about cuts to interest rates right now. So strong message there. Dollar CAD had a little bit of a rally, didn't do an awful lot. I had my levels picked out, as you well know, from yesterday. Anything up towards 135 or these 132 lows was where I was looking. Didn't even get remotely close to that. So I sat on my hands for that one. One trade that pair that Kay was looking at was Euro CAD as maybe the mover, because we were right up near or within good range of the strong resistance area up there. And a few of us decided to pick this one as our Bank of Canada pair of choice. So a few of us are layered into shorts up from sort of the 146.30s up to the 146.40s. For the moment, the level's holding, and this highlights what I say about stretch points. Looking at your levels, you know, we were down here into the BOC, mid to low 145s. So you're looking at the areas. If you get a move, where might it run into trouble? Well, a big solid, you know, triple top, quadruple top, whatever you want to call it, historically strong resistance level is a natural place to think you might want to park the bus. Hence why that's the pair we picked to scale into. It's not out the woods just yet. This may just be a little bit of a pause. We are just edging below 146. That's what I want to see. I want to see us get below 146 and hold. Then maybe we get a move down back towards these lows and see where it goes from there. So as I say, that's why I look at stretch points. That's why I look at those levels in dollar CAD 135s and the lows at 132s. If the price is going to move, it's the big levels it's got to take out. If it doesn't, then you've got a chance of a trade somewhere to lean your risk against and have an effort rather than trying somewhere in the middle. While we're still in Canada, PM Trudeau came out saying that the government will not take any more fiscal measures that further contribute to the Bank of Canada needing to fight inflation. So they're not going to be looking to put any pressure on the Bank of Canada by any further fiscal means. Bloomberg had a piece out, I think it was Bloomberg or Reuters, one or the other, saying that housing demand has climbed in the US, and that a report from Redfin Corporation on housing saying that pending home sales increased for the first time in more than a year in December. Now, what we did see yesterday was another little improvement or positive number to, where are we going? Get the right page. In the NBA data, you'll know that I watch this quite a lot, just to give a a rough indication of what's going on. Mortgage applications posted another gain, up 7% from the 27.9% prior. But as I've been warning, this can be a bit of a New Year effect. As we can see, you can get some solid numbers when you come into the early part of the year. We could be seeing that at the moment. What I want to see is if this keeps trending into the new year. If you look at it from the index basis, which will give you, let's look at a purchase index, so it gives us a decent number. You can see what's been happening for the last year or so after finding some decent tops. You know, all year it's just been coming lower and lower and lower, and has only just picked up now into the new year. So as I say, whether this is a sign of a turnaround, that other data on pending home sales might be an indication that the housing market may have found a bit of a bottom. That's data we're going to have to watch over the weeks ahead. That's all I've got from the headline stuff. Anything you've spotted with your eagle eye still?
I wouldn't call myself eagle-eyed, but
It's like the old action man.
it was actually quite light in terms of headlines. Didn't really see anything. I mean, we're in the period of earnings now, so I guess one thing that did stick out a little bit was Tesla when they reported their profits, and they reported better than expected profits, but that's on the back of them cutting prices. So they're sacrificing profit for volume.
Margin.
It's they kind of have to do that because competition is catching up or has caught up already. But no, other than that, I mean, there was no real headlines that you didn't cover. So yeah, we can carry on.
Very much. I will do that indeed. So today we got a fair bit of data out, jobless claims out, and GDP, the first number for Q4 from the US. So that's something to keep an eye on there. It's a funny one, these GDPs. It's the end of year stuff. It's backward looking stuff. You know, we've already got an indication of what's been happening this month so far. You know, we've started to get the PMIs out and some of the other faster private data. So really the GDP, the first number is usually the most, if it's going to bring a move, it's usually the first number that does it, unless you get a big variation on the revisions. So we're expecting GDP to come in at 2.6% versus 3.2% prior. So there's two ways of looking at this. If we get a number round about as expected, nothing really to trade on, maybe a bit of positivity that things weren't worse. If it comes in much higher than expected, that's going to play into the soft landing narrative. That may see yields firming up a bit, maybe the dollar firming up a bit. I doubt it. No one's going to think that a firmer GDP in Q4 is going to cause the Fed to start being far more hawkish than they are. At most, it will have them reiterating that rates are going to stay up for longer because there's not the economic weakness that they've been expected. Conversely, if it's a terrible number, then the market is definitely going to push more to the weaker side and the dovish side to say that things may not be soft or landing as softly as expected, and that will be forcing the Fed not to go as high, cut much earlier, so on and so forth. So for this number, it's going to be a bit binary, the reaction. I would look at perhaps a range, you know, maybe 3% to, you know, maybe 2.4%, something like that. Anything in between that sort of area is around expectations. Anything, you know, much lower than 2.2% or higher than 3% will get a bigger reaction in the dollar today. You got any thoughts about GDP? Still, do you think it's just going to be roundabout, or any surprises?
This is a good question. It's always a tricky one. The first sprint, right?
Yeah.
I don't know. It's a really tough one because I think, you know, as high rates continue and as QT continues, we are seeing a slowdown. That's for sure. The only part of the economy that's still doing well is inflation. Sorry, not inflation, is employment. But we have seen a number of pretty bad leading indicators, PMIs and New York, what was it, the Empire State numbers, all that. So my guess is that the economic activity and growth is dropping. Now we are expected to have what is it, 2.6% year on year, quarter on quarter. We're expecting. If you had to ask me, I think it's the most likely scenarios we get a slight disappointment. Same with inflation, same with GDP. That's a trend, I think. But obviously, one number can be on either side. So I think that the main theme is still disappointment. But of course, on one number, I mean, who can predict? It's a tough one. I would guess a couple of tenths below the expectation. That's my guess.
Yeah, I think it's going to be there or thereabouts. It would be a surprise to see a big number either way. So I think like you say, 2.4 on one side, maybe 2.8 on the other side. Anything else will be a bigger surprise. I would say keep an eye on this number, real consumer spending. That'll be a bit of an indication on how the consumer fared in Q4. We know that November and December retail sales weren't very good. It's only one expectation I've seen is that number is going to come in at 2.9%, or expected to come in 2.9%. Keep an eye on that. That might be one of the ones that the market looks at after the headline GDP number. And from that data, we'll have to keep an eye on obviously the rate expectations for the FOMC next week. I doubt it's going to change anything significantly. It may just see a bit of a shift around between what we're pricing. And at the moment, we're pricing a 25 pip hike at 97.9%. If we get a strong GDP, that might switch that more towards the 50 pip hike expectation, which is currently the balance at 2.1%. I personally still think there may be a bit of a risk that the Fed go a 50. I think that risk is a bit more than what the market's pricing. So if they do that, that'll be a bit of a shock. We have been speaking about the financial conditions thing. So if the Fed really wanted to stamp their foot down on that, they could go a 50. It wouldn't be something that would be out of their bounds. They've said they can go rate hikes as much as they want to do, even if they are going to start slowing down. So they could do a bit of a stamp there with a 50. But we shall see. A lot of the market going for 25. Likely it will be 25, but I just think the risk is higher than what a lot of the market are saying at the moment. So looking at pricing, we'll have a look at dollar yen. Again, data. We'll have a look at where the price may run into trouble if we get a big move. For this one, we're probably talking up maybe to this 131s area again. That would be an area I'd look at if we get strong GDP numbers. As I say, I don't think it will change the Fed either way. So if the market reacts to that, I see no reason why it should break significantly above that. Conversely, a poor number, I don't see why we would break down here in the 127. So that would be my area. It's probably a bit wide. I'll be very surprised if we get to those levels, unless it's a big number either way. But that's what I'm going to be looking for in the interim. Those are my ideal places where I'll be looking to trade. Maybe I'll have a look at down into these 128s if we get down there. Certainly we're closer obviously to the 131s than we are the 127s, hence why 128 may be a consideration. But that's what you should be doing, folks. You should be looking at your charts, picking the levels that are decent range away from where we are going into the number, and see what we do there. I'm still short on this one, so I'll be looking just to scalp it, a short-term trade, anything I do, unless I get something juicy to add into my core position. Aussie dollar, as mentioned, another move up towards the highs, early doors today. didn't really get much over the fix that I saw yesterday, so maybe that's had its run its course. Did get a smaller move up around the fix, but it was nothing compared to what we saw these prior days that you can see here. So maybe that's all done and finished, or the market's got bored with it. We are still knocking on this zone up in the 71, 30, 40 area. Had 2 goes at it now, so we're not straying too far away from it, which potentially sets us up for a break higher. After we had this failure yesterday, we got down to the broken resistance point here at 70.65, and I jumped into a long against that level, just playing the level, which I've done the usual slice and dice up to 71.20. I'm gonna see if we get a break of this level, and then maybe I'll look into take a bit more into my next level, which is up at that call it 35.60 zone or 35.70 zone. If we get a move up there, I want to take a piece off and then fold the rest into my core long, which I've been chopping and adding to, as you guys well know. Conversely, if we can't see this 71 area held up here, and I want to see it hold really strongly, if at least this 70, 90, 70, 80 area. If we can't do that, then likelihood is we're going to see another one of these moves where we can't break a level and we get a steeper pullback. So I wouldn't be surprised if we get back under 70.65. I wouldn't be surprised if we come back all the way to 70, maybe even worse. Hopefully before then, trying again and building up for another run towards the highs. But certainly the trend remains in place. It just seems we're hitting the speed humps a bit more often than we did previously. Euro sterling, it feels like your tires are getting pumped, and then it feels like someone sticks a knife in and all the air gets let out again. Still overall going sideways unless we get up here, bust this 89s, or break below 87s. We're going to be ranging from here. I'm still sitting on my longs, strumming my fingers on the table, waiting. I will be looking at a break trade to add into the position up here towards the 89s. It's it's maybe a similar situation to euro dollar, messing around here in my zone, not really getting the breaks, clearing this 109 area, still having to put a real attempt at this 109.40 area, which is more a long-term level. As you can see there, goes back to this period here when we had the breakdown originally. So it needs to clear that 109.40s. I know Still's got a few up there as well, or some of the other guys. Needs to clear that. Until it does, this whole area is still becoming a bit of a sticky zone. And that's why we look at them, because historically they are sticky zones. And when you get a sticky zone, it can stay in there for days, if not weeks, before it makes a decision. So, on a longer term basis, you have to respect these areas. And that's why I like to see them cleared entirely. And it's a big area, 108s to 109s, has to clear it properly. As soon as we break that, and if we start to see support coming in here, that's when you tend to get the kickers on. We could be 110s, 112s, 115s from that point onwards. It's always these big levels that can make or break a bigger move thereafter. Still, you got anything you want to talk about on the metals or anything like that?
Yeah, a couple of things. First of all, I want to answer Gavin's question. If housing if housing picks up again and prices start rising again, demand rising, rents high, any thoughts on how the Fed will feel about that? Well, clearly, if housing goes higher, then this gives the Fed more ammunition or more ease of mind to keep tightening. But with rates having already gone up, with mortgage rates having doubled or more for a 30-year fix in the US, from what I remember, even I think maybe even tripled. I remember 30-year fix was below 3% at some point. Now it's over 7 or something like that. So with these rates going as high as they have, it's very difficult to, or it's a lot harder to refinance, to buy, to borrow, all that. So this has definitely put a brake on the US housing market, and I really don't see that reversing anytime soon unless the Fed starts cutting like crazy. So, to answer your question, of course, the Fed will not like, if housing prices go up, it will make life easier for the Fed in terms of tightening. But I see that as a very low probability scenario, at least for the short term. Let's say for this year. After that, obviously, who knows? But market-wise, we
Well,
are kind of
on
on the
that.
cusp for euro dollar and for the S&P, both at resistance. The euro dollar, you have it there. The S&P is a descending trend line resistance, which is there or thereabouts. It's been broken a couple of times, but really hasn't been able to hold above. So we are, we are there. It's not convincingly breaking out yet, and I don't think it will before the Fed next week. But the market feels like it's getting short now, and it's because this trend line is so important. And because it kind of makes sense to be short equities, I think more and more are getting sucked into the trade with stops above. So I think it's dangerous to have a squeeze, and I think that now a squeeze is the most likely scenario, even though it doesn't make too much sense. I think it's the most likely scenario because of positioning, because of because of the Fed next week, and it's the Fed has reasons to not be hawkish anymore, or as hawkish as it was before, because inflation is coming down at a decent pace, and that's what they always want to see. It's not like they're going to see inflation go from 8.5% to 4%, within a couple of prints. It's not, but it's doing it's taking some big chunks off every time, and as long as that continues, and I think this pace will continue in the US, the Fed will be very comfortable leaning towards the dovish side slowly as we go forward. So 25 and done, I think it could be the case. It could be. But market wise, as I said, the euro dollar, the S&P, they're at levels where they're about to break out, but not doing it convincingly yet. So I'm still waiting to see on that. I am going to get long on a breakout of stocks. I'm going to get long for a trade, for a short term trade. I'm going to get long like a scalp. Same with the euro dollar. Metals, you mentioned, up one day, down one day, still in bloody no man's land. Gold is moving less than silver, as always, but we still haven't broken out. Gold is still there. There you are. It's still bullish. I mean, look at this impulsive move higher from the low 1600s. It's still going. Yes, momentum has faded a little bit, but it's still going. And next week's Fed could be the trigger for the next leg higher. And if we do break, if we do continue on a dovish Fed, I think we're going to new all-time highs, and silver is going to be playing catch up. So at the moment, it looks like the market's trying to decide, is losing a little bit of momentum, but price action is still bullish for gold. It's a lot more sideways for silver, so I wouldn't call it that bullish for silver. I think there's a higher chance of a pullback in silver, but again, it's gonna hang on the Fed next week. So otherwise we're just seeing a lot of chop everywhere. There's nothing concrete happening anywhere.
Yeah, and just go back
to my humble view on markets today.
And it's always welcome, mate.
Always 1972 welcome. Is the 78 fib of that move in gold. Okay, 1972. Fine.
There we go.
We're almost there.
Yeah, and just go back to what you're saying.
Ryan?
Pardon? Hello?
We can't hear
you. Hear me? Oh, hello?
We can see your screen, but we cannot hear you. That's interesting.
Oh.
Or is it me? Oh,
No,
Can you hear? I
oh
can't
yeah,
hear
you
Ryan. Is
can't.
it me?
Oh, you can hear me, but someone
Oh,
can't hear.
oh, there you go.
You.
There you go. Sorry, but something happened here,
What
and
did you do? What did you do?
I don't know. I went to my settings, and for some reason, my mic had gone off to a
Blocked me.
different. My mic had gone to a different setting. I don't know. My headphones have gone to a different setting. So if you were trying to talk while I was speaking and I didn't let you interrupt, I'm really sorry. I couldn't hear anything.
Oh, I thought you were just being rude, but
Sorry. It was
no,
me.
it's no problem.
Apologies.
I was about to say, I was going back to what you're saying about house prices, what Gavin was saying. Yeah, you got to take a bit of context as well. You know, one of the things that rocketed up really quickly were mortgage rates. You know, they were busting up to 7%. So that's naturally had an effect on the housing market, maybe sped up pretty much what we've been seeing all year. You know, the housing market hadn't done well all year. And that was one of the things that perhaps the reason why the Fed have let financial conditions ease off the gas a bit is to take a bit of the steam out of those mortgage rates so that the housing market doesn't enter a sort of collapsing phase. It has its own sort of soft landing. So naturally, there may be some pickup from that, Gavin. I don't think the Fed would be that bothered if the housing market started to pick up because of the trend it's been in for the last year or so. They would rather a pickup in the housing market than a collapse in the housing market in that sense. Charlie's asked a question for Euro CAD and Euro Sterling. Am I correct to be bullish on these two pairs given their apparent divergence in their central banks? Well, it's an interesting question. But you have to remember, Charlie, what's important is central bank expectations. Okay, what the Bank of Japan did yesterday, what the Bank of Canada did yesterday was pretty much confirm something that they'd already previously touted, i.e., getting to the end of their hike cycle. Now they did that at their last previous meetings, so that was already being factored in by the market. Okay, then we got the ECB obviously turning more hawkish this summer, Lagarde turning far more hawkish, culminating in telling us that we're going to get further hikes and they're going to continue hiking. So probably all that is what this is all about here. This expectation that the Bank of Canada is already going to slow and maybe pause, and the ECB are going to get more hawkish. So this is the trade you would have wanted to be on for that divergence expectation in the market. Right now, we've had confirmation that the Bank of Canada have paused, yet we haven't broken higher because the market already knows that the ECB is going to hike at probably 50 BPs next meeting March and maybe thereafter. So for now, you know, that's already priced. This divergence is already priced. What changes this pricing now is if something changes at the central banks. Let's say the ECB turn up next week and say, actually, we're hiking 50 pips, then we're going on pause. The market isn't pricing that. Now you're going to get a different divergence trade. Now you're going to get maybe the CAD gaining, the euro dropping, because the market's expecting them to go on. Then they tell us they're going to pause. Now, what would change euro CAD from here, now that the Bank of Canada's on pause, is the ECB. Maybe Lagarde comes out and says, actually, we're going to hike 50 and then we're going to hike 75s. Okay, that's not what the market's expecting. That will get you your next divergence move in the currency because it's something new. But that will only get you so far. The market will move, it will price it in, then it needs to do something more. So the divergence trade is always the expectation. What is the market expecting, and have we priced that already? And then you look, well, what isn't the market pricing in and what isn't expected, because that's going to bring the next move. You know, we could get 2 months down the line and inflation stops dropping in Canada and the market starts thinking, well, actually, the Bank of Canada might need to get back into hikes. They're going to start pricing that into something like EuroCAD well before the Bank of Canada come out and say that they're going to do that. So it's all about divergence, is all about the pricing and the expectation rather than what actually happens if confirmed, like we saw yesterday. And the same thing for euro sterling. You know, we know what the the Bank of England is supposed to be doing, a 50 hike, then maybe a slow to 25. We know what the what the ECB are doing, hiking away. We're not seeing any move out of it. So if you're bullish on these two pairs, that's fine. For Euro Canada, you've got a trend in play, but we're banging our head against a strong resistance. So if you want to buy it, you want to be looking for a dip. Conversely, go for a break if we get a break, because a break is likely to kick on up. And it's similar for Euro Sterling. You know, we know what the Bank of England's doing. We know what the ECB is doing as far as the market is aware. So it's going to need something different to move this price again. Maybe something different from the ECB or something different from the BOE. In the meantime, if you're bullish, then you have to have some patience and look for your levels. Wait for the decent levels that will give you a greater chance of getting in and staying in a trade, rather than just going, oh, I fancy buying it here, and you're trading in the middle and you're stuck in the middle. And maybe it goes up and maybe it goes down and it waffles around and you're sitting picking your nose. Wait for the decent levels. Do your planning, pick your levels. If we get down here, maybe worth that's getting long, depending on the reason why we're down here. Conversely, look for maybe a break of 89, and that'll be the kicker to get it up there. And maybe something's changed that caused that move to happen. So I hope that's given you a bit of insight for that one there. Let's have a look. Anyone else got any other things? Come on, guys. You're all letting me down. Let's hear some questions. Let's have some juicy stuff from you. Stocks I'm interested in, and Stel was talking about it a moment ago, the S&P. And just to go back to that, I think if I was looking at the daily, I think if we keep this daily, if we keep today above this line and we hold it as support, I think that might be the kicker for a move up to maybe the 41s. You know, it's been waffling around. It can't hold. It can't stay above. It can't stay below. A bit of indecision. This is a lot of people, as we were saying this week, and Stel mentioned, was shorting up here. You know, the 4,000 level, a big level. It's just holding above it now. So that's your first real signal that shorts perhaps aren't working around here. But I think watch today, particularly for this GDP data. If it's bad and we can't, and we still stay above this trend line, that's going to be a signal that, yeah, maybe we're going to start going higher in the sessions ahead. So that's my clue for that one there. Nikita, Aussie, pound Aussie, and yes, on your radar for a breakout in either direction. Oh, let's look at Euro Swissy on that one. So what breakout are you looking at for here? This breakout above parity, the one level, for a move back up. Got a few levels up above here. It's again, this is going to be a bit all about the euro over the Swissy. I think we've got a meeting, SMB meeting. When's the next meeting? March, because they have one quarterly. They're expected, it's a fine line, they're expected to hike either 50 or 25. It's pretty even, 53% probability of a 50, 46.7% of a 25. So they are expected to hike there. They're still on 1% interest rate. So they're still going to be lagging the ECB. So that's one area where you may see this divergence playing out. But it's not showing an awful lot here. But if it gets above this area, call it 10090, 101, then perhaps you're looking at a big move back up. The downside is still really a bit messy for me. It looks like, you know, it needs to hold this 99 level. If it breaks that, then we're heading a bit lower. Pound Aussie, I don't even think I've got it on my chart, to be honest with you. Let's have a look. Let's see if it's in a little bit. So there we go. Pound Aussie, not one I look at a lot. Again, what are you looking at from a breakout standpoint? Because this already looks like we've had a break below this 1.7, call it 1.75, 1.74 and a half. Already had a breakout there, and it's looking like it's resisting already. So while that's happening, if you're looking on the short side, That's your area you want to lean on. No, back above 175, and likely we're going back in the box. Long way to the upside, 1.82 for that one. You're looking more short-term stuff. Let's have a look at that for you then. Okay, so that, to me, that just re-emphasizes this 175 area. Break, holding, typical textbook. You've got a low in place down there. So that's your range, 175 down to these lows. You know, if we get down to these lows, test and hold, you know, then perhaps we're finding a little bit of consolidation, and then you've got your battlegrounds. You either look for a break here for a further move down, or as I say, back above here, we go back in the box further up. Cool beans. I hope you smash the pips on that one, whichever way you trade. So good luck with that one. Well, if you good ladies and gentlemen don't have anything more to deal with, maybe we shall call that a day.
Thank you, Ryan. Sorry, I sounded really offensive before. I'd rude.
I'm used to it, mate. I'm used to it now. You know. No, I don't know what happened there. It's all good. All good.
All right.
Yeah. Perfect. Hopefully, we've given you some good pointers for the GDP later on. So trade safe. I want to hear some happy stories that you made lots of pips. Should the markets move in favour for you? I don't want to hear any horror stories. So please trade safe. Thank you as always to Stelios. Kay, I think, should be back in tomorrow at some point. He's like a whisper in the wind these days. Trade safe. Thank you very much. We shall see you all tomorrow.
Thank you, Ryan. Thank you, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.